I'm here today to talk about our global asset allocation for 2024. We're much more sanguine on global growth and consensus, in particular on US growth. And that has certainly translated this month, in our view for the months ahead, in terms of a more pro-risk stance for risk assets relative to safe assets, as you can see here. Now, this view is slightly nuanced in the sense that we're not just sort of saying go long equities versus bonds. We do have a sort of intra-asset class calls here on a cross-asset perspective. So, for example, we prefer DM. We're underweight DM equities versus EM equities. We're also underweight DM bonds versus EM bonds, and we prefer high-yield credit to equities overall. One of the things that helps us guide us, as well as our colleagues' macro views, is the fact that we have our cross-asset frameworks here, which also point to a pro-risk stance. So that's our global asset allocation overall, moving to a pro-risk stance. So, our analysis shows that, as you will have seen from our macro colleagues this morning, that households are not particularly stretched at the moment. Debt service ratios continue to be manageable. Our household financial balance model, which incorporates the unemployment rate and other factors such as the financial obligations ratio, is consistent with the retrenchment that we've seen a bit in sort of consumer balance sheets, but we expect that to have already petered out as we speak, and things will improve going forward in terms of households. For corporates, it's pretty much the same picture. The terming out of debt, especially during the post-pandemic period in the early sort of months, has meant that corporate balance sheets have stabilized, and we think corporates are actually in a better shape than markets may expect. So we expect the speculative default rate really to not reach more than 5%, to be in the sort of 4.5% to 5% range throughout this year, and that is obviously much lower than recession peaks we've seen in the past.